2022 has been a pretty terrible year for the stock market. It's been the worst year since 2008, and analysts and investors and experts are already predicting a recession for 2023. And if you're sitting here as an investor thinking about investing your own money, it's probably pretty scary right now to be thinking about investing in the stock market. So in this video, I'm going to share with you the experts' opinions of what they think is going to happen in 2023. We're also going to look back at 2022 and see what experts were predicting before 2022 to see what actually happened. And we're going to learn a little lesson there about just how expert these predictions are. And then, of course, as always, I'm going to share my real money portfolio with you. I have made some changes to the portfolio. I've made some sales of some companies I really like for tax loss harvesting purposes. We're going to get into that. And then I'm going to share with you my outlook for 2023, my strategy, and what my approach is going to be moving forward. Okay, so now we've jumped over to a Yahoo article that has some expert projections for the S&P 500 for 2023. And then we're going to look back at what some of these experts were thinking for 2022. So as of December 1st, the median forecast from 17 strategists for the S&P 500 at the end of 2023 was 4,000. The highest at 4,500 comes courtesy of Deutsche Bank, and then the lowest at 3,400 comes from a firm called BNP Paribas. It looks like Morgan Stanley, or this guy Wilson at Morgan Stanley, expects 3,900 for the S&P 500. And just for reference, right now the S&P 500 is sitting at about 3,800. And so if we look down at those expectations, the highest here is for 4,500, which is about an 18 or maybe 20% gain, just doing it math in my head, which is not good to do in public. But then basically 4,000, that's almost flat, just up a few percent. And then 3,900 is barely up at all, basically flat. Lowest at 3,400 is down 10 to 12% or something like that. For an S&P 500 of 3,400. All right, so we talked about their expectations for 2023. How accurate were their 2022 expectations? And they were not accurate at all, which is all you need to know about expectations. As of November 2021, the median of 12 forecasts was 4,825, and that's according to Bloomberg. The highest was 5,300 from Brian Belsky of BMO. The lowest was 4,400 from reliable bear Michael Wilson of Morgan Stanley. So apparently Michael Wilson is always bearish. With 3 trading days to go in 2022, S&P 500 closed at 3,829. So well below even the most bearish of predictions, which means people are just too excited, right? And so now the question is, are people too bearish? I don't know. What I do know is that on average over the last 100 or so years, the stock market goes up 2 years out of every 3. So 66% of the time, 66% of years, the stock market goes up. That is what I'm investing for as a long-term investor. I'm going to stay invested, and I'm going to continue trying to be invested in the best companies I can for the long term. That's my strategy. So that brings me to some changes that I've made in the portfolio. And I have sold some stocks. I sold stocks off. I'm going to cover those now. But the portfolio is still fully invested, and I still plan to add to it every single month. And so I just took the money from what I sold and invested it into companies that I already owned, and I'm going to talk about why. But first, tax loss harvesting. What, right? First of all, do your own research and talk to a tax professional. But the basics of tax loss harvesting is that there's 2 ways that it can help you manage your taxes. An investment loss can be used for 2 different things. The losses can be used to offset investment gains. So if you had $10,000 in gains in a year, and then you came towards the end of the year and sold $10,000 of things that were down $10,000, you could offset those gains. If you don't have gains, like me, this year I didn't have gains, the remaining losses can offset $3,000 of income on a tax return in 1 year for a married couple filing jointly. And if you don't use it all in a single year, if you have more than 3,000, for me it was closer to 10,000, then you can roll the leftovers into future years and offset taxable income in future years. There's a bunch of articles out there on tax loss harvesting. I'm not a tax professional. This is just what I did for my own portfolio, my own decisions, my own situation. I linked to an article. This is my email newsletter, which is free. There's a link to my newsletter in the description below where you can read this article. But in there, I linked to a Fidelity article that explains tax loss harvesting. And there's a ton out there if you just Google tax loss harvesting. All right, here is what I bought and sold. And you can see over here, I sold Cloudflare. I sold CrowdStrike. I sold Mongo Database, and I sold Bill.com. I didn't like selling these companies, and generally I don't make any decisions for tax loss harvesting because, as I just covered before, it really doesn't offset that much in taxable income unless you have gains to try to offset. And I try to make decisions based on what companies I want to own, because the opportunity cost of selling a stock that potentially goes up 5x or 10x or something like that is much larger than, saving a couple $1,000s here or there on taxes. You're literally talking about the potential for, tens of thousands of dollars, hundreds of thousands of dollars, depending on how large a position was. But since everything was down so much, I was able to reinvest into some of my favorite cloud and SaaS companies, and other companies that aren't cloud and SaaS, like Taiwan Semi, Mercado Libre, Rocket Lab, and Tesla, that are just down so much that I don't think there's that much opportunity cost of selling what I sold to reinvest those funds into things that are also down and have just as exciting of growth potential as the companies that I reinvested into. And so you can see I added to GitLab. Brookfield BN is a new position in the portfolio. I did a video on BAM, BAM, and BN, essentially Brookfield Asset Management and Brookfield Corporation, how that whole distribution took place and my thesis for investing in those. That's a video in the channel. Just check out my channel. You'll find that video. Taiwan Semi I've talked about. Just hard to find a company with as much of a competitive moat and market dominance as Taiwan Semi. Datadog is another dominant, very, very efficient with their gross margins, their path to sustained profitability and sustained growth. I'm going to talk about that in just a second. Mercado Libre is, e-commerce in Latin America, and they also have other exciting stuff going on in payments and advertising. Rocket Lab is my favorite little rocket company that's very risky and very volatile, but a company that I'm very excited about long term. And then Tesla, everybody's heard about Tesla. I think now, just my opinion is, gonna 5-10 years from now is gonna prove to be a great time to be adding to a position in Tesla. All right, so here is the portfolio on the last day of trading this year. I think it's the last day of trading this year. $111,951. Ooh, what a horrible year. We are down $1,700 today, down 1.5% today. Full transparency, this is how much we are down year to date. We are down $26,000 year to date. We have put $138,000 in. And so you could see we're down quite a bit. Again, I am a long-term investor. I'm investing money that I don't plan to need for at least 5 years. And so my focus right now is to continue piling as much money into the stock market as possible while maintaining my income and actually hopefully increasing income and having a cushion financially on our personal finances so I don't have to draw from this money. But in my opinion, if you can keep your income, if you're responsible with your finances and you're investing extra money and not investing loans and a margin and crazy options, now for me is the time I'm putting as much money as possible into the stock market for 2023. That is my plan. And you can see here's the portfolio as it stands today. Meta is the largest position, 24,400. Taiwan Semi's next, 12,500. Shopify, 10,400. Rocket Lab, 10,000. Datadog right at 10,000. Snowflake, 10,000. Tesla, 10,000. GitLab at 7,700. Mercado Libre at 5,600. Brookfield Asset Management, BAM at 5,200, and Brookfield Corp at 4,900. I basically look at these as one position. Now we're going to use fast graphs to just run through revenue expectations and some projections on how I think these stocks could potentially perform over the next several years. And then I'll talk a little bit about why I sold the ones I did and why I kept the ones I did. And again, a lot of this is, I think, basically software as a service and cloud companies are going to kind of trade in tandem if they're all going to do bad or they're all going to rise, right? Over the short term, at least. Now, over the long term, I think, the best of breed companies, the ones that continue to execute and continue to outperform, are going to be the ones that perform best as investments. But we are just talking about from a tax loss harvesting perspective. I could buy back into these companies in 31 days, although I don't know if I will or not, because the bottom line is, for me, Snowflake is going to be just a dominant company of the next decade. Datadog is just extremely capital efficient, and I believe they're also going to be dominant for the next decade. And then GitLab is much smaller than the other two, but it offers a lot of upside and growth, in my opinion. And then the thing that all three of these do better than the ones that I sold is they have the highest net dollar retention rates, which is how much their current customers spend from 1 year to the next. Snowflake, Datadog, and GitLab have higher net dollar retention rates than Mongo Database, Cloudflare, CrowdStrike, and Bill.com. Bill.com is a little bit funky, but they've had a lot of inorganic growth. They have grown a lot through acquisition. All right, so first up, we have Mongo Database. And what we need to cover with these graphs is over here, we can see the current blended price to sales ratio. Down here, FastGraphs has a pretty cool feature where you can put in analyst expectations. So these are what analysts are expected for revenue growth per share. Now, not just straight up revenue growth, but revenue growth per share in 2024 and 2025. So that does factor in share dilution or if they're issuing shares. And so what I've done with basically all of the SaaS companies is beyond what is in there for analyst expectations, I just put growth out 20% for the next 3 to 4 years after that. And I do think it's possible that they continue growing revenue at that rate or higher. But I wanted to use 20% as a baseline to show you that with what analysts are expecting over the relative short term, if they all just baseline to 20% revenue growth and then trade it at around the same price sales ratio, which ones have the most upside? So that's kind of what I was looking at with that, right? For this, we'll really just go out to 2026. We could go out further, but we're just going to go out to 2026, maybe 2027. So for Mongo Database, with analysts expected revenue per share growth of 25% in 2024 and 26% in 2025, and then 20% the next year, if they traded a price to sales ratio of 10 in 2026, the share price would be $346, which is a total return of 74% for almost 20% annualized. I'd be very happy with that return. Now, if they trade down to a price to sales ratio of 7 and hit these growth numbers, then you would have a 22% total return for 6.65% annualized. Okay, Bill.com, we have analyst expectations for 2023, 24, and 25, and then I put 20% in for 2026. Out to 2026, if you get a price to sales ratio of 10, you're looking at a 72% total return for almost 17% annualized. Down to a price sales ratio of 7, you're getting 21% total return for about 5.6% annualized. Okay, CrowdStrike, another one that I sold. Again, going out to 2026. Price sales ratio of 10 out to 2026. It currently trades at about 11. Price sales ratio of 10 out to 2026. You're looking at an 88% total return for 22.7% annualized. Price sales ratio of 7, a 31.7% total return for 9.3% annualized. Cloudflare, the last one I sold. So going out to 12/31/2025, which is the first year beyond analyst expectations. Price sales ratio of 10, you're looking at a total rate of return of 42% for annualized of 12.41. Price sales ratio of 7, you're looking at a total rate of return of negative 0.5% for a negative 0.17% return annualized. Jumping over to what I bought, Tesla was by far what I bought the most of. We're using adjusted operating earnings or PE, not price of sales. And so analysts have expectations of 36% earnings per share growth in 23, 24% in 2024, 14% in 2025, and then I put 18% in 2026. And so you can see right now it trades at a blended price to earnings ratio of 30. So out in 2026, if it hits these numbers and trades at a blended price sales ratio of 22.5, which is a pretty big reduction from here, then you have a total return of 70% for a total annualized return of 14%. If it trades down to a PE of 18, you get that total return of 36% and an annualized return of 8%. Okay, Brookfield, this is the other one I added $5,000 of just to get that BN position started, right? And so right now, this is why I'm excited about this opportunity. So it's trading at a blended price to earnings ratio of 12.27. So if it stays around a price to earnings ratio of 12 out to 2024, then you're looking at a 34% total rate of return for almost 16% annualized. If it jumps up to a PE of 15, you're looking at 60, almost 67% total return for 29% annualized. All right, Datadog. This is really the first of the cloud and SaaS companies that I added to with these funds. And so we could see analysts expect 33% revenue growth per share in 23, 34% in 24, and then 39% in 2025. So then if we look at 2026, I did 20%, which is a big drop. I think it'll be growing faster than that, but we'll see. So total rate of return out to 2026 will be 111% for 20% annualized at a price sales ratio of 10. At a price sales ratio of 7, which is a pretty big drop from today where it's trading at about 14 blended price sales ratio, you're looking at an annualized return of 10% per year. All right, Rocket Lab. Hard to know what this thing will trade at on a price to sales basis. Earnings is really hard to forecast, especially, over the long or short term. But we see analysts are expecting revenue per share growth of 37% in 2023, 56% in 24, and then 60% in 2025. It's currently trading at a blended price sales ratio of 8.25. And so in 2025, if it's trading at a price sales ratio of 6, then you're looking at a total return of 151% for 35% annualized. Even if it's trading down to a price to sales ratio of 3, if they hit these growth numbers, which there's a lot that can go wrong, so do your own research. I've done a few videos on why I'm excited about Rocket Lab. Obviously, you have to make your own decisions. This is not a recommendation for you, just sharing my thoughts here. But even at a price sales ratio of 3, you're still getting a 7.88% annualized return out to 2025. And then beyond that, if they keep growing, which the launch industry and then some of these other markets they're entering are expected to continue growing for a very long time, then you have a lot of potential growth ahead. All right, GitLab, another software as a service or cloud type company. Analysts are expecting 40% growth in 2024, 37% growth in 2025, and then I brought it down to 20% growth in 2026 at a price to sales ratio of 10 at that time, down from 16.93 today. You're looking at a 41% total return for almost 12% annualized, down to a price sales ratio of 7. You're looking at a negative, basically 1% total return for negative 0.3% annualized. All right, Snowflake. Snowflake is expected to grow pretty fast, and they've grown pretty fast at scale already. Analysts are expecting 57% growth in 23, 46% growth in 2024, 40% in 2025. And then again, I brought it down to 20% in 2026. So trading at a price sales ratio of 10, down from 23 today, you're looking at a total return of 10% for annualized rate of return of 3%. Now, I think if there's any of these that deserve or is going to trade at a bit of a premium, I think it could be Snowflake. Either that, or I think they'll, surpass these growth expectations. At a price sales ratio of 15, at that time, you'd get a 65% total return for 17% annualized. But again, that's with a lot of heightened growth expectations in there, and also trading at a premium multiple. So something to keep in mind with Snowflake. All right, finally, Taiwan Semi. Taiwan Semi is more simple. It trades on a cash flow or price to earnings basis, trading at a blended price to earnings ratio of 12. And analysts are expecting negative 5% growth in 2023, and then back to 16% and 14% in 24 and 25. And so if it trades at a price to earnings ratio of 15 in 2025 and hits those numbers, you have a total return of 64% for 18% annualized. It continues trading at 12, which I think is a relative low. Then you've still got a 33% total return for 10% annualized. And finally, Mercado Libre, which out of all of these could be the most undervalued for kind of the history that this company has. It's just a long-term market beater. It has destroyed the S&P 500. I'll show you its performance in just a second. But analysts are expecting 22% revenue growth in 2023, 27% in 2024, and then only one in there, but they're at 20% for 2025. This thing is historically traded, I think, around a price to sales ratio. It's better to look at this thing on price to gross profit or price to gross merchandise value. something along those lines. But because of this tool, we're using price to sales, and it's a fair way to look at it. But it currently trades at a blended price sales ratio of 4. So if it trades at a price sales ratio of 5 in 2025 and hits these numbers, you're looking at a 127% total return for 31% annualized. Even if it trades down to a price sales ratio of 3, which I don't know if it's ever traded this low, or at least not in any recent history, you're still looking at a 36% total return for almost 11% annualized. And if we look, this stock has been a long-term beater. So since 2007, compound annual growth rate is 25% versus 8% or 8.5% for the S&P 500. And then, yeah, it's at a price sales ratio of 4.15 right now. And I can't find another time that it's traded this low, not even back. And back here, it's a much more risky company, much less established, even during the great financial crisis. So it looks like 2008, it got down to 3.78. Okay, so if we have another 2008, you could see a slight reduction in price sales multiple. It got down to, 2.85. Still, that's like the worst of the worst case scenario, basically. I don't think we're in for another 2008. And I think that this company is positioned as good as ever to continue growing and continue dominating their market. And so I feel really great about owning Mercado Libre for the long term. Thanks for watching. I hope this was helpful. If it was, the best way you could support me for free is to like the video, subscribe to the channel so you never miss an update, and check out the links in my description. I'd love it if you subscribe to my free email newsletter. Thanks. Let me know if there's any stocks you want me to review down in the comments below. I'll do a subscriber review video coming up.